Financial Services Committee, Republican Congressman Warren Davidson of Ohio. So, Congressman, thank you so much for being with us. Give us a sense from your perspective what the president should want to talk to his financial regulator about.
David, and look, I'm glad the president's meeting with his regulators because, this space has needed attention for some time. Frankly, we're talking crypto especially, but the whole state of financial regulation is having a hard time keeping up with the FinTech innovation that is, moving much faster than regulators can. So I think one of the big things that he has to talk about is how do we do, federal policy that makes it clear what is a security and what is not. That's Gensler with the SEC. You have XRP, for example, is a cryptocurrency that could be very useful for the payment system. But Ripple, how separate and distinct is that as an entity? And if they exercise a lot of control over it, it might look a lot like security. If there truly is a firewall there, it might look like it's not a security. And we've tried for a long time to get a bright line test there to make it so it's less subjective for regulators. And, one of the encouraging things is Gensler really understands that. He taught blockchain courses at MIT prior to taking this current role. So it's good that he has some expertise there, and hopefully he'll listen and have good dialogue.
So, Congressman, give us a sense of whether the regulators who will be meeting with President Biden have the authority under current law to do what you think needs to be done. I know you have a bill, the Token Taxonomy Act, to try to make sure, I guess, that the SEC has jurisdiction over certain things.
Well, I mean, what you've seen in this FinTech space for a while is really regulatory arbitrage. So, there are people that really are securities, and they've tried to kind of game the system so that they can avoid, heavy-handed securities laws. And look, there are plenty of those that I'd like to change. What my bill does is it doesn't really eliminate any of those laws or even change them. It just makes it clear, there's a Supreme Court decision that created this thing called a Howey test that applied to orange groves in the 1950s. And if it was speculative and you were still planting but there wasn't an orange crop, well, then it looks more like a security. And that leaves a lot of discretion. So to regulators, what we're trying to do is say, whether you're a regulator or you're a FinTech startup or a venture capital fund looking to invest in this, you shouldn't have to worry about somebody coming in after the fact and by regulation, by enforcement, kind of blowing up the whole deal. You should know straight away, we are a security. We're going to be regulated like a security. You can't, arbitrage the system. Or let's be clear, this is not a security. Even if the SEC doesn't like that it's not a security, it falls on this side of a bright line test, then there's a different regulator. That's one of the main things there. One of the other pieces in crypto, because private keys can be shared with multiple folks, is custody issues and who has custody of it. Technology has largely solved that, but it hasn't solved it for regulators. And then the third piece is tax, and of course that's got its own sensitivities, but it would treat crypto the same way it treats other currency in the de minimis exceptions.
Congressman, give us a sense, because you know this area so well, of what are the problems we're trying to address. Is this a matter of using crypto for illegal purposes? We saw that, for example, in the ransomware situation. Is it protecting consumers, or is it protecting our ability to control our money supply, protecting the Fed in a sense?
Well, look, I mean, these are all important issues that we had a good hearing last week. I'm the ranking member, lead Republican on the FinTech task force. And we had a hearing last week on the central bank digital currency debate. And frankly, there are people that really just want a digital dollar that isn't distributed ledger. It doesn't use the blockchain technology. It uses the same architecture, maybe with different or better encryption than what is currently commercially available in the U.S. But it inherently has a central authority. It uses the same kind of failed system of trust that is subject to breaches, just like the Colonial Pipeline. And people are making a lot of, crypto because it's being used for ransomware. But the reality is, the federal government seized over $1 billion in crypto transactions last year because it isn't really private. It's not completely secret. If it's on chain, on the blockchain, you can follow all the moves all the way to the off ramps, and that's exactly what happened in the Colonial Pipeline. So there are people that actually favor it for tracking illicit finance. We don't have our regulatory framework right on that piece, and so whether it's a central bank digital currency or anything else. I think if you get a secure architecture, true distributed ledger technology without a central authority that can filter the transactions, it could be permissionless like cash is, and yet not be completely secret. It has a way to be traced with, probable cause that a crime occurred. And instead of using the money as a system of control, you could focus on the crime itself instead of causing some of these economic distortions that you see in the current system.
Congressman, finally, to move beyond cryptocurrency for a moment, the reports are that President Biden wants to talk to these financial regulators in part about the issue of climate and the need for disclosure, government-required disclosure of the consequences potentially for their business from climate. Now, whatever you think about the climate debate, do you agree at this point it's become material enough that companies are going to have to start disclosing?
Well, that's a key word there. Material impacts are already a fiduciary duty for disclosure. So, companies that can say they have a material adverse or favorable impact due to climate change would already be obligated to disclose it. What Democrats broadly want regulators, Secretary Yellen, Secretary of Treasury, but Chairman Gensler in particular, to do is mandate that public companies are required to disclose, and they want it in a kind of standardized format. Now, they're pushing this on climate, but they're really pushing it on a whole broad set of environmental, social governance criteria. And so you try to measure every company the same way. There are merits to that argument because it would be standardized, but I think for any company, given the current culture, saying that you don't have a material impact from climate change would be looked at, oddly by some folks. And the reality is there are lots of companies that's not a driver for their balance sheet, their cash flow, or their income statement. It might be a personal goal of the management team. It might be something that investors find interesting and, kind of social cause investing. But not every business model has that. And so they're going to see the debate, but I think they've already got a foregone conclusion in terms of what they want to do. It's just how do they do it.
Okay, Congressman, really a delight to have you with us. Thank you so much for joining us. That is